Hey guys, Brian Stevens here with the National Real Estate Post, but coming to you from the National Association of Mortgage Brokers, I have Dave Stevens. He is the founder of Mountain Lake Consulting. Dave, how you doing today?
I'm good, Brian. How's it going?
Good. You've been busy lately. Lots of interviews.
Yeah, well, it's an interesting time. So,
It certainly is. Hey, listen, last time we spoke, we were talking about some of the changes that Mark Calabria was making over there at the FHFA. He was not going to go into what HUD did with the pass-through assistance program. It appears that if forbearances get too high and it stresses our servicers, that he's looking at reassigning some of these portfolios over to banking servicers. Is there going to be, are servicers going to want to deal with non-performing loans? Is this something that's realistic?
I don't think it's realistic at all. Let me tell you what's happened since we last talked, because there's a lot of pressure being laid both at the Treasury Department and at the Fed. So first and foremost, Chairman Powell of the Federal Reserve gave an interview to the Brookings Institute last Thursday. This question came up during that interview, and he was very explicit to say that the Fed was very concerned about the non-bank servicers in particular, and was watching it closely. Indicators are that they may actually consider putting up a liquidity facility. I know the NBA has been working hard on it and has sent letters into the Fed asking them to look at this. Similarly, there's been two letters from Congress. One was both very bipartisan, by the way. One was from the Senate and was 50-50 Republican, Democrat, went to Mnuchin and Powell, asking them to intervene and create a liquidity facility. The letter from the House that just went on Sunday night, a couple nights ago, that was also a bipartisan letter from members of the House of Representatives asking for the same thing. Today, there's an article in Bloomberg that quotes a lot of the folks, Brian, that you're aware of, we've talked about before. It quotes Chris Whalen, who wrote a pretty aggressive piece. Chris is a well-known analyst in New York and trader background in the MBS space. But it quoted former folks from the administration, Jim Parrott and others. But that article today just talked about how Wall Street doesn't like Mark Calabria. It quoted Michael Bright from SFIG and others. And then the Treasury Secretary Mnuchin last night gave an interview, and he actually said he's very concerned about the non-bank servicing and is looking at ways to get involved. So, this circle's tightening around Mark. And I think the concept of letting a big servicer fail or servicers fail, pulling defaulted servicing and sticking it with some bank, as you point out in your question, is kind of a ludicrous proposition, because nobody's going to want to take on the expense, the cost of that non-performing servicing. Technically, maybe not non-performing, but the reason why a servicer would go into default, frankly, is because they'd have an excessive amount of loans in forbearance, and they wouldn't have the liquidity to make the advances. So that's the reason why the servicer would fail. So anybody who takes that on would be inheriting all of that liquidity expense. Someone would have to pay that price or subsidize them for that work. That could cost the GSEs just as much as putting up a liquidity facility. And so, my hope is either Treasury prevails on Mark to do something. And the reason why I think that could happen is, remember, the preferred stock purchase agreement, the contract that has the GSEs in conservatorship, is between the Treasury Department and each respective GSE, with the FHFA as its regulator. Treasury's the single biggest shareholder in these two companies, and they have a huge ownership stake in how the PSPA operates. So it's not like they're a non-vote here, and they can certainly put pressure on Calabria. I think there are other pressure points being made on members of the president's family who have friends on Wall Street, who know people who are very concerned about this. I know there's letters being sent from people I don't want to state here, but I saw a copy of a letter from a very influential Wall Street player to Mnuchin. And so these things are happening. So I think at the end of the day, I don't think we're going to see the dominoes fall as failures. But again, you raised the most important point here, which is, in your question, uh, who's to think that anybody's going to want a bunch of loans that are in forbearance and take on all those advanced requirements and ultimately the workouts that happen on the back end in this process. And that's why I think ultimately one of the federal agencies, whether it's FIFA, the Treasury, or the Fed, there'll be some form of liquidity facility set up in time before we start seeing these failures happen. That's my guess, but I don't think all is lost at this point.
It reminded me of, when I was thinking about this, of the old Countrywide Bank of America scenario. I'll buy them. No, I don't want them. You're going to buy them type of thing. You're going to service these loans. Question here with the Treasury. If they do put together a liquidity facility, would they be able to skirt the FHFA and go directly to the servicers, or do they have to get the blessing of Calabria and the FHFA if, in fact, they did put that together?
No, they don't. The servicers can go to any borrowing window that's open to them, and so I don't think the Treasury necessarily would create the window because they don't have that capability. They have the money. They're the bank, so they could give the Federal Reserve the money to set up a facility. The Fed is used to windows, as you know. There's a Fed window now that banks can go to. And by the way, Brian, I think for the mortgage brokers as well should be aware of this. The banks won't have a problem here because they have an advanced facility. They can go to the Fed window and borrow as regulated depositories that the Fed supervises. They can do that all day long and exchange their servicing assets for borrowing or just do pure borrowing from the Fed window, depending on which structure they go with. They can also go to the Federal Home Loan Banks, which have a liquidity facility that banks have used for years. They have that capability. It's just not open to non-banks. So what Calabria is sort of doing here is screwing the non-bank community for something that's no fault of their own. So I think that if the Treasury were to get engaged and not convince Calabria to do it, they would help support the financing needed for the Fed to create a window that would, in essence, exchange a commitment, a lien on the MSRs against liquidity advances being provided to the MBS investor on behalf or to the servicer so they can extend to the investor. All that structure would have to be created, but they're used to advanced facilities. They have them in a variety of construct at the Fed today. It's just a matter of now saying, okay, non-banks can now get access to this. So again, I just don't know why Mark in particular wants to be the goat here. It just makes no sense to me why he wouldn't realize that the entire pressure of the entire financial services community is looking at him as the obstinate blocking point here. And I hate to be so rude about it, but after Chris Whalen's piece, I figure you can say anything these days. And we really need this. It has to happen. And so I think that it would go a long way to calm the markets. And Brian, I don't want to go just to step into it. I think what you're seeing in terms of 700 minimum FICOs on warehouse lines and correspondent pipelines being put out by one of the largest banks is a sign of the insecurity around having non-banks sort of be counterparties to them in any way, shape, or form. So, the tightening of credit we're seeing has a lot to do with Calabria's decision not to calm the markets here.
It's kind of a silly question, but everything that I've read on this, I haven't found anybody in support of Calabria's position, and I've been searching for this. Is it as simple as he's got a bone to pick? He's just anti-non-bank? Or what do you think? Can you speculate as to what his agenda is, considering everybody seems to be against him?
Yeah, I think it's one of three pathways, maybe a combination of them. He discounted one of them in the Bloomberg piece that just came out, but the one perspective is he's really focused on trying to get recap and get housing reform done. And I think that also includes guys, if the GSEs are recapped and released, I just want to say it's going to be a much smaller looking GSE in terms of what they're able to do. But nevertheless, I think he wants to get that done. He's worried that if they now have to do all these advances to servicers, that's going to really destruct their capital base, as well as maybe pull from the line of credit at Treasury and it'll almost put a stop to any opportunity for recap, at least before the election, or even steps to get investment capital behind that. So, and I think there's movement there, and I think folks like Ackman and Paulson and others who are big investors in the GSE shares might be whispering the same thing. That's one possible angle. Some validity to it, although Mark said, and others have said, they think that the concept of recap and raising equity now, given all what's going on, is probably not going to happen anyway, at least not till well after the election and well past Corona. Second possible reason, he's a traditional free markets libertarian, and he has said, many times, I've testified with him in front of Congress and have met with him over the years, and he's been very clear that he doesn't think that the government should step in and bail out private companies to back the housing market, that the market should kind of live and die on their own, unless it's, he's articulated a little bit about too big to fail risk, and maybe that's when you step in. He does sit on FSOC, which is a Financial Stability Oversight Council, which is primary mission is to protect against too big to fail risk. So maybe he believes that you should allow smaller institutions to fail, kind of like the way we let Lehman Brothers fail back in the Great Recession, which I think now in hindsight, a lot of us believe was a mistake, but that's water under the bridge. The third possibility could be, as you said, his concern about non-banks. He has publicly stated in interviews months ago that he thought non-banks were unto themselves as a market segment, a systemic risk to the housing finance system. And I think for all of us listening here, we ought to I ought to just make clear, we all constantly need to reiterate to policymakers that we come in contact with, this was not a failure of the non-bank market. This was a failure caused by a virus and some aggressive legislation that went well beyond anything previously passed, that gave everybody a free put on their mortgage. And yet all it did is shift the burden of who makes the house payment from consumers to the banking system, a lot of which is held by non-banks, and that burden was thrust onto them. These assets are actually owned by the GSEs. Freddie and Fannie own the MSRs. They own the servicing rights. It's been a decades-long debate with the GSEs, but they own the servicing. These servicers service on behalf of Freddie and Fannie. Freddie owns all these servicing rights. It's their responsibility to make these advances when a program like this is thrust on the nation. So I don't know, that's a lot of response there, but I do think it's one of those 3 points. Either is concerned about how it impacts GSE reform. 2 is kind of just general philosophical libertarian beliefs as an economist from where he sits. Or third, potentially, or in tandem to that, potentially just believing that we should, let the non-banks fail because they're a risk in general.
So in Calabria's defense, the one thing that I did see is the early prognostications were we were going to see 25 to 30% of all Fannie and Freddie loans that were going to be in forbearance. I've seen all the articles; they're up 2,000, 3,000%. The time on wait for Mr. Cooper, the 86,000 that they had forborne, and I just saw forbearance requests are up 78%. With all of that said, for Fannie and Freddie's portfolio, it still seems like it's only sitting at about 3.5%. We're not nearly the 25 to catastrophic 30%. Could you make an argument that Calabria is right then in that sense? Or do you expect a spike in forbearances?
I can make the argument that the numbers are going to go up. So even in the release that MBA released, which is the numbers you're citing about what's happened in forbearance so far, remember, we're just a few weeks into April. A lot of people are making payments. In fact, I'm hearing from servicers, they have borrowers who are approved for forbearance and still made the April payment. The longer we go with unemployment here, the longer, and as those numbers grow, the more the increases we're going to see in forbearance. So that's point number one. To add to that, it wasn't an estimate of 20 to 25%. It was a what if scenario. So they're like the MBA, amongst others, many others. Mark Zandi put out a piece as well with a few folks, the economist, Mark Zandi. But they both similar said, if it gets as high as 25%, this could be the overall impact. So no one knows exactly where it's going to go. This is completely uncharted territory. But I will tell you, everybody in the business and every economist looking at this is convinced it's going to go a lot higher from where it is just in this first couple of weeks of April since the forbearance plan went into effect. final point I would make, Brian, is markets hate uncertainty, and so what Calabria doesn't realize is waiting till the pain points are reached, while not giving the markets confidence that they will step in if it's needed, is what's causing all these credit pullbacks, all these overlays, everything. Warehouse lenders, the reason why they're tightening what they want in their pipeline, what they'll allow in their pipeline, is they don't want to get caught holding the bag, because now Marcus said he'll let them fail. They don't want to have a whole bunch of pipeline. They don't want a big pipeline of loans that then they have to ultimately dispose of. So they're putting credit limitations on their pipelines for warehouse lending, just in case the non-bank fails, because they can't make the advances and no one's there to bail them out, and they have to ultimately settle those loans. They want loans that will absolutely sell, close to par or better, not at a discount. And so the reason why you're seeing overlays is a direct on warehouse lending, which ultimately means you can't originate them, is a direct result of the fact that Mark is not creating an environment of certainty in the financial services market. And can I add one more point, Brian?
Please.
Look at what the Federal Reserve did. The Federal Reserve stepped in immediately, and Powell has reiterated time and time again in every single interview, including this one just a few days ago, that they're going to be there. They're going to step in with force. They're going to continue to step in and do whatever's necessary. There was no waffling, no hedging, and the markets loved it. Look what happened to the stock market after Powell's comments, and look, it's crazy what's happened, that the markets remain as solid as it has. But a lot of that's coming from confidence from the Fed and other aspects of how they view this thing planning to play out. Congress immediately acted and passed the biggest bailout package ever in the history of this country, quickly signed into law by the president. Practically no votes at all on the bill, because they stepped in with force. Why? And threw money everywhere. Maybe in ways that I'm not totally in agreement with. Doesn't really matter. They threw money everywhere because that's what you do when you're in a national crisis like we're in today. And Mark, a regulator with responsibility, nominated by the president and confirmed by Congress, is unilaterally doing just the opposite of what every other leader in this country is doing, including President Trump and Congress and the chairman of the Federal Reserve, who jumped in with guns a-blazing to make sure that they did everything possible to cushion the blow to this nation on a financial basis. And yet here we are, totally disrupting the mortgage markets. And as we both know, and everybody listening here knows, when we come out of this and go back to work, we're going to have a lot of housing demand. If we have screwed the market and compressed credit availability to an extreme extent, it's going to take quite a while to come out of that. And that could slow the pace of recovery that this nation is going to be so dependent on as we move forward. So I don't think Director Calabria, with all due respect, having never been a practitioner, never worked in the markets, only been primarily a policymaker in Washington or thinker in Washington, I just think his short-sightedness and obstinance could single-handedly be a major cause of pain as we try to get this country back on track when we go back to work.
I was having a conversation with a loan officer up in Michigan. It's a long-winded way to get to my question to you, but one thing you're not hearing about is the unintended consequences of the actions that we're seeing from the FHFA right now. So we saw in an article, we're not spilling the beans here, but Chase is saying, okay, you need to have a 700 plus credit score plus 20% down, or we're not doing your loan right now. I understand where they're coming from as a knee-jerk to the policies that are in place right now, but I'm thinking to myself, that's leaving a lot of people on the outside looking in, our underserved communities across the country. It's just, who gets hurt the first and the worst? Well, it's always the underserved communities, and oftentimes minority communities. I see overlays with lenders. They're coming fast, they're coming furious. It's every single day. And lenders right now, loan officers right now, are being counseled that if they believe that client to go into be a high probability to go into forbearance almost immediately, to not fund a perfectly fundable deal. The question that I had from a loan officer, he said, I service two communities essentially outside of Detroit. One which is affluent and primarily white, and one which is a more urban community, which is a heavy density of minorities. And what's happening is if you're not making as much money, there's a higher probability. If you got $1 million in the bank, you're probably not going to forbear over here. So there's a belief that there's a lot of people in these underserved communities that are going to take advantage of these forbearances, And there are loans that are not getting done right now that are perfectly doable loans that would help these folks out, refinances, cash out rate and term, all that type of stuff. With all the overlays that are in place in scenarios like that, where we will forbear one perfectly good loan, but not another one, and understanding that it's going to, by and large, run across socioeconomic lines and ethnicity lines, are we creating a fair housing and a fair lending issue right here that could affect lenders down the road?
Yeah, I mean, the short answer is yes. Look how extreme it is right now. Yes, Chase announced the 700 minimum. I looked at their bulletin, so it's not like you can't see it. It's not in the public domain. But I did a survey yesterday of a large number of larger non-bank originators, and I asked them what else is happening in their overlays. I had a list of specific questions. In fact, Brian, I'll send you an example of one of the answers when I'm done. It won't have the company name, but it was pretty consistent. Bond lending virtually stopped, and nothing with down payment assistance. And basically that's all bond lending is down payment assistance. So in the end of the day, that's a first time home buyer program, heavily minority populated. And,
right.
I think that what we all need to look at is if you study HMDA data, which I'm not sure most people do not, Home Mortgage Disclosure Act data. The most recent reporting shows that for African Americans in this country, we've made virtually no headway from 20 years ago. Whites have a high home ownership rate that grew. Even Hispanics are growing, although at a much slower pace. In terms of percentages, they're growing in numbers because of the demographics, but they're not growing in percentages. And, we have a real challenge as a nation created historically that doesn't have a lot of inherited wealth to be passed down generationally. And so if you're a first-time home buyer in the African-American community, you may be the first in your family to own a home. And so how do you get access to home ownership? You get it with lower down payments because, again, you don't have inherited wealth. Mom and dad can't help kick in for the down payment like I did for my kid, my daughter, and will do for others. And you also, because you don't have the inherited wealth and backstops, you will tend, as a mean average, have a lower credit score than white non-Hispanics. And so to your point, all of these overlays, 700, that's going to be a very white borrower population. Right. And we're seeing it with bond programs, FHA lending, reserve requirements, and more. And if you read the Chase document, it wasn't just the 700 minimum FICO. If there's a self-employed borrower on the package, they have to have 12 months of reserves, 12 months to be approved. I understand why they're doing it. And my worry is too many others are following you. And to the point you laid out in your when you were framing the question, this is changing by the hour. And what I've learned in my career is no one wants to be the point of adverse selection. So if someone sets a threshold at X for a credit score or whatever, highly likely that the majority of the industry is going to eventually follow. Will it go to 700 and JPM's rules? That's a little extreme, but you know what the overlays that are happening. You're seeing it on the street as you talk to folks out there, 640, 680, depends on the product and cash out or rate and term and those kinds of things, FHA or agency. But it's a big deal. Now, I got to do the forbearance piece because you raised that. Don't close a loan if the borrower is going to go into forbearance, even if it's sellable. Why? Right. Freddie and Fannie have a policy in place that you cannot sell a loan that's first payment forbearance. You'll have to own it. And more importantly, if it goes into forbearance in the first 15 days, they'll kick it back to you as well. Huge risk on the investor from that Rep and Warren standpoint. To me, that's another foolish decision because Ginnie Mae, who was always the most inflexible operator in mortgage finance, suddenly is looking like the king of helping to solve our problems by creating their liquidity facility. And likewise, they're at least stating for now, you can take a first payment forbearance that's insurable and put it in a Ginnie pool. And so, I'm really just shocked at how this all goes back to how Calabria, and ultimately because the GSEs have to follow his direction, are causing all of this contraction from a credit availability standpoint. And you're right, it's going to crush first-time homebuyers and particularly minorities the most.
And that's what I keep hearing. And I'm looking at these overlays, and it's just kind of here we go again. I got two more questions for you. The first one is everybody's pulling back. Our jumbos are gone. Our non-QM is gone. Our overlays are through the roof again. This is starting to feel a little familiar to me. You know, that 2009, 2010, when our credit availability swung from the pendulum went from super loose to incredibly tight, where very few people could get a mortgage, and it took a long time. It took years to get out from underneath that. On the path we're at right now, assuming, snap our fingers, we kind of get out from underneath this thing in the next few months, how long is it going to take for credit availability to come back and start servicing some of these communities that are clearly going to be collateral damage at this point?
Well, it's a great question, and I wish if I had that answer for you, I wouldn't be doing these interviews. I'd be betting on the markets with precision. But here's my own perspective is, as to your point, the more the pendulum swings to one side, the longer it's going to take to come back the other way. And that's why the more confidence we can have and provide the financial markets in general about backstops, the more likely that they're not going to contract as much as they would have otherwise. You remember the response to the last recession, and keep in mind, the last recession, home prices dropped roughly 24% from peak to trough in this country. So we had huge negative equity problems in the sand states and the brown states, as we call them, manufacturing states. And we had, huge unemployment because of a truly real recession brought on by a credit erosion in the housing finance system, and credit tightened. But I don't think it tightened as much as we're seeing today. I remember the standard overlay on an FHA at its worst got to be about 640 as a minimum FICO. I'm seeing higher ones out in the marketplace right now. And the caps on refis, the caps on bond programs, and those kinds of things are pretty extreme. There's a way you don't repeat that pendulum from going as far as it did. Especially since this wasn't brought on by a credit event. We have actually awesome demographics for housing, unlike that period in time. And we have a shortage of available housing supply, unlike that period in time. And, it's all of this is coming from uncertainty. And the only point of uncertainty left right now is the result of this one individual who heads the directorship role at the FHFA, and ultimately the GSEs, inability to respond even if they wanted to, because they have to comply with their director's orders. So that's where we sit right now, and I worry that that's going to delay the time frame for recovery for bringing credit back in, because you and I both know this market's being driven by the millennial first-time homebuyer. That's what's driving the entire market. McMansions in the $1 million+ range or $2 million range in communities all across the country are really still slow. We weren't seeing appreciation there or high demand. Where we're seeing the massive demand is the entry-level housing and move-up market. That's the millennial generation. And those are the guys who need the availability of credit to be the widest more than any. And I worry greatly about how long it's going to take to come back, because that's going to impair the recovery of the economy.
So again, Mark Calabria right now is somewhat of an enigma to me. So I'm just trying to figure this out from his perspective. Ginnie and HUD seem to have done, I guess, a fairly decent job with the pass-through assistance program and their approach to this. Could it be that they've got 3 times the capital reserves of what's required, their congressional mandate right now? They were kind of left alone over the past decade, so they're capital rich right now. Whereas we had the quarterly sweeps with the GSEs, and I think the last time I saw they have $20 billion right now or so. Could it be the policies that were in place for the past 10 years with the GSEs as opposed to HUD, or maybe one of the reasons why he might be going down this road, or am I completely off base on that?
Well, I have a pretty strong opinion on this subject, and I remind everybody, I ran the single family business at Freddie Mac, and I saw some of the mistakes being made. I left in 2005. So it was several years later that the crash happened, of course. But, I saw how market share went to the largest banks, because the GSEs gave sweetheart deals to Wells Fargo and Countrywide over smaller banks and independent mortgage bankers. I also saw the risk taking that took place, and I saw the actions in the retained portfolios of Freddie and Fannie being used to buy tranches off of subprime securities. They were buying a lot of NODOC, a lot of Alt-A, because it was yield rich, and they failed. So Freddie and Fannie collapsed and failed, and it was the Bush administration that had to come in and bail them out in 2008 and put them into conservatorship. So, having them wind down and be restructured, I think was the right thing to do. And, we've been trying to figure out how to do that. All policymakers have ever since. But to think they only have 20, whatever their capital is on their balance sheet as a sole resource, I don't think it's the way to look at it. They have a $240 billion line of credit, fully funded, solely for their use, sitting at the Treasury Department. They don't have to ask for it. It's automatic, just like permanent and indefinite authority, which is the legislative text that backs FHA and Ginnie Mae. These guys have it in the form of a $240 billion line of credit, already funded by Congress. It's not like new taxpayer money that would be spent, and that's their capital. So, if anybody wants to use that shell game and say there's not enough capital, that's similar to how we used to look at the MMI fund at FHA and then the capital reserve, and everybody would say, well, they only have 2% capital, but that was just the capital reserve. They also had the MMI fund, which holds the majority of the reserves to pay losses. But people wouldn't look at that. They play political games. And I think we can't get caught up in that here. GSE's got plenty to tap into. Just put the numbers in context. There's $240 billion in the line of credit. If you take the worst case example that the GSEs used in their what if scenario, or Mark Zandi, the economist, used in his, that comes out to somewhere in the range of $70 to $100 billion max. If you use $70 to $100 billion max as advances, that's a temporary drawdown on the line of credit. The vast majority of those loans will reperform, and they'll come back in terms of payment plans or in partial. I'm not going to talk about the Ginnie Mae side. So, but that'll come back in the form of advances. Let's do the math just a little more. Their estimate was a total of about $70 to $100 billion, depending on who you read, of which about 40% of that is Ginnie Mae programs, FHA, VA, USDA, and 60%, let's say, is the GSEs. So now it's 60% of the $100 billion. So it's $60 billion, using the bigger number, of which the vast majority of those loans will ultimately reperform, and that liquidity will come back to the line of credit. So not only is the line of credit available, these are high credit borrowers who the vast majority are going to go back to work over time and the forbearance period is well long enough to get the economy back in gear in terms of employment. And so you're really not ultimately dipping into that line of credit, except for those loans that ultimately go into default. And guess what? The GSEs have to pay for those anyway. That's their guarantee. So I just think this, people who need to understand the machinery here, the money's there. It's in a checking account, sitting in Treasury in their name. They can draw from it to do these advances. There's no excuse, just like flat out no excuse not to back the market with a promise of liquidity if needed. And that in itself would help ease the daily, hourly tightening we're seeing in the credit markets that's going on right now.
So with the government's preferred purchase stock agreement that they had back during the last bailout, they essentially have the controlling shares of Fannie and Freddie. Do you expect to see something change in the near future, even if Mark Calabria doesn't come off point, or do you think there's going to be enough pressure to get him to come off point? Because, I mean, there's a light at the end of the tunnel right now, but it appears to be a train coming at us.
Yeah, that was the point we discussed earlier. I think Mnuchin's comments last night were really helpful. I don't know when this will get shown, but his comments on the 13th on TV of April were really helpful. And my own sense of this is either the Treasury is going to force Calabria as the majority shareholder of the firms and the joint owner of the PSPA. Actually, they are the owner of the PSPA. Calabria is not. And then it'd be a battle between regulators, kind of, which the Treasury, I think, holds the trump card. Or there's the Fed that would come into play and create a facility. So I don't know how it's going to play out, Brian. I just can't imagine that policymakers in DC, having done everything with such overexertion, both through the Federal Reserve, through the legislation, to cushion the blow, that they're going to let this whole market disrupt. And I'm not sure how it happens. I'm not sure it'll be without pain. I'll give you just one example how this can hurt. Even if you do forbearance, in some states, since they may only advance if they create liquidity. They may only provide liquidity for P&I, not TI. There are some states where the TI is more expensive than the PI. Yeah. New Jersey, for example, where the property taxes are 4 to 5% and your interest rate's only 3%. So the reality is you're actually paying more in taxes than you are in principal and interest. So even if they come in to help liquidity for principal and interest, the servicers still have a lot of liquidity they're going to need. So, this only cushions the blow if they come into play. And I think it would help us get through this. But again, who's going to blink first? We'll find out.
Wow. Dave Stevens, I appreciate everything that you brought to us today. Thank you so much. Is there anything that we missed that you'd like to convey to everybody?
No, I mean, I'm glad I had a chance to talk to the National Association of Mortgage Brokers with you, Brian. I did one with the other group, but NAM has been around for such a long time, and you guys are really critical to the housing finance system. As you know, I ran wholesale for Wells Fargo and worked with brokers, and you know your communities well, and you really fight fiercely for the consumer, and you give them choices. And so the one thing I am confident in that, once again, large originators, particularly banks, are going to realize in this slowdown period that having a retail sales force is pretty darned expensive. And they also may realize after they advance all this liquidity, you saw some of the write-downs that were announced this week about MSR values on some of the biggest banks. It may be really slow for them to re-enter the market, which, by the way, I think only bodes well for brokers and independent mortgage bankers, who this is all you guys do. All you do is mortgages, and you can grow very quickly. And so this is a good opportunity to talk to brokers, because you're going to have a quick recovery out of this, and you're going to be able to recruit, I think, pretty aggressively if you're an owner of a mortgage broker firm or an independent mortgage banker. I think you both similarly have complementary value propositions in your own way. So good to be here with NAM, and Brian, good to be with you again. And Roy, keep up the good work.
Dave, thanks so much.